So this was the first session from the reformed corporate and sustainable finance working group. The next session that will follow is the financial risk management working group right now. So I would like to welcome on stage right now Alex Griffiths from Fitch Ratings, that he's going to provide us 2023 first half corporate outlook. Thank you.
So hi, I'm Alex Griffiths. I run the corporate analytical group for Middle East and Africa at Fitch. You've got a Fitch 20 minutes, I'm afraid, but very different topics. So I'm not on the sustainability side. It's all about credit ratings with me, so a complete change of tack. I'll keep it quick. So I'll start by talking about the macro and then move into some impacts on corporates. We've got the panel session afterwards, and we can delve into some of these points in a bit more detail in that session. So starting at the very top, and I spoke to you last year, and I'm getting slightly depressed at giving these speeches because the big story hasn't changed, right? Stagflation, interest rates, growth is all still there, but there are some developments more recently that we should talk about. So if we start on the growth side, the chart to your left shows what's been happening in the first half of this year. So how our revisions to our forecast GDP have changed and our expectations essentially for the global economy. The blue bars show what's been revised in 2023. So the first half of this year, we were feeling pretty positive. Generally, 23 revisions were in the blue and going up. But what you'll note is that the red bars, which is 2024, were counterbalancing that. So essentially what we were seeing was this long drawn-out process of where we expect some kind of slowdown which will cure the inflation problem just being pushed back and back. So growth this year stronger than expected, growth next year a bit slower. There are a few bits we need to discuss within that. First of all, there's the US. Now, we last revised our forecast formally in June. We do it quarterly, so no points for guessing. There's another one coming quite soon. Since we did that, the US has been performing very strongly. So the US consumer just doesn't know when to stop spending. Despite all these interest rate rises, they're keeping going. We think that will stop. We think that the huge rises in interest rates in the US will have an impact. We're still expecting a mild recession sometime late this year, early next year. It'll be mild, but it will be probably a more robust landing than some people are expecting. China is the blue bar on the end. Now you'll note that's slightly out of order because they're otherwise ordered as they go up. That's because I changed that manually and my slide work's not that good. But that reflects a change we made last week to China's growth. So we were expecting China to grow at 5.6 this year. We've taken that down to 4.8. Reflecting essentially the fact that the reopening of China hasn't lit that flame. It sort of flamed and then kind of died down again. A lot of that due to policy. So we think that the Chinese policies have not been as enthusiastic as they've been in other reflations the country's done, as they try to balance credit growth with more stable growth. The property sector is also still really struggling to get back on its feet in China, and that's bad news. Why does it matter for us sitting in Europe? Two reasons. One, commodities. There's obviously a big pass-through to commodities. Secondly, capital goods exports. So particularly if you're in Northern Europe and Germany, they export a lot of equipment to China that we expect to slow down. The final thing, and the slightly better news story, is Europe. So if you look at the Eurozone in there, which is, where's the Eurozone? There. You can see that the revisions upwards aren't balanced nearly as much by revisions downwards next year. So this was the positive impact of getting through the winter without Russian gas. That was better than expected. Unfortunately, what we've seen this year is, it wasn't minus 8-9%, which is what we were really worried about, but it is causing some parts of manufacturing to shutter. So the energy-intensive parts of manufacturing have shut down, and that's having a negative drag on growth. So Eurozone growth probably a bit slower than we thought. If we look at it in the round, the big story, though, which is the graph on your right, growth's going to be slow. You know, if in the developed world, growth is really, you're looking at 1% over the next couple of years on average, which is just not great fun if you're a corporate. Two other very quick macro points I'll touch on. The inflation picture is improving. So, you know, I say this is a very slow process we're moving through. We are moving through it. Inflation started to come down in a lot of countries. Thank you. It's hard to completely write it off. You know, I think we can see things generally moving in the right direction, but there are bits, there's services growth, labor markets are still tight. There are things in there that still worry us enough to say that we haven't won on inflation yet. It feels a bit like being in a sort of bad horror film where the whatever monster you're fighting just refuses to go away. But we think we're getting there. What does that mean? It means that, again, we think we're seeing peak rates sometime in the next 6 months or so, but the drop-off is going to be slower than the markets are predicting and not very dramatic. So they'll peak and come down a little bit. We don't see a return to COVID-era interest rates or financial crisis level interest rate anytime soon. We think those rates will stay in a similar kind of place to where they are, albeit a little bit lower. So a couple more things. Interest rates have been driving market access for a lot of people. It's been very hard to price bonds, price debt. We've been lucky in the sense that there hasn't been much of a need to refinance. We went into the current interest rate rising environment with a lot of corporates having refinanced in 2021. We're starting to see in 24 and 25 more material refinancing needs. So there's going to be more competition out there for debt. The good news is that with interest rates starting to peak, the mood with investors I'm talking to is they do want to actually deploy money. So they're looking for things to invest in. What that means for the corporate sector is essentially more red on this slide than I'm used to showing. So a difficult position operationally for many corporates, but not necessarily the worst place to be. And these aren't credit outlooks, these aren't rating outlooks, these are just measures of how the general environment in a sector is. And you can see it's difficult, but we're not seeing, if I cut to this slide, we're not seeing negative rating actions matching that slightly negative sentiment on sectors. So where we are, and the best line to look at here is, this is developed markets, this is cumulative rating actions since pre-COVID, it's a flat line. So essentially, we're going neutral or actually slightly positive in terms of net rating actions, reflecting the fact that yes, it's slow growth, but corporates have seen this coming for a long time. They're taking actions, they're cutting costs, retailers are doing all the clever things they can do to somehow make you keep buying the same things you were buying and maintaining their margins. And actually, there's a slight net positive rating. But at the same time, the environment's not so good that people are going out doing M&A, they're returning huge amounts of money to shareholders. So we're seeing enough cash being generated to improve balance sheets, but not so much that people decide that they're very comfortable and can extend themselves. A slight note of caution is this, which is the rating outlooks that we have. So these are ratings, and this is just the portfolio. How many are on negative rating outlook? You can see it's gone up ever so slightly from 10% to 13%, but that's still a very normal place. What this is reflecting for us is differentiation between companies. So when we're forecasting, talking to companies, we're seeing everyone with a plan, and most of those plans are working. There are a few companies where they're not working, so that's essentially what the negative outlooks are telling us. And the other place where that's an issue, and I haven't got it on this slide, is if you were to compare the very bottom end of the market, so single Bs, leverage loans, that's where there's a lot of leverage and floating rate debt, and there is essentially far more default risk now, because it's all about market access. And if you take 7 or 8 times leverage in a company, you layer on base rate increases, and then you've got to refinance with increased spreads as well, that can be quite painful. It just means that some capital structures out there don't work in the current environment, and they are often having to default to improve those capital structures. Finally, risk register, which I put on every single slide deck I do in case I need to say more things and somehow don't fill the time, but I have. So a few things just to put out on here. The obvious risks are at the top, the big ones. So high interest rates, stagflation, China, all very much with us. Financial system collapse, I think we'll discuss a bit of in the panel. Gas shortage, we know about, we can largely cope, but it's not easy, and gas markets are going to be tight, prices are going to be volatile. And then I'll just skip to the bottom one, which is this one. Yeah, I don't know, there's question marks. Generative AI is coming, it's potentially transformational. The risks seem to be around the way it disrupts markets and polarizes winners and losers. If you get it and you make it work for you, then you could do really well, and if you don't, you could be left behind. But frankly, I'm sure there's a lot we'll find out about that area that we don't know yet. So suffice to say, we're just looking at it very closely. With that, I'll move on to the risk panel.
I would like to welcome now on stage Dimitris Siokis from Coca-Cola, Stella Dimaraki, Aegean, and Ioannis Seimenis from Eurobank. We're going to have a very interesting discussion on adapting to a higher risk environment, E2E risk management for corporate treasurers. Thank you.
Thank you. Good morning, everybody. As Mariana mentioned earlier, we're going to talk now about financial risk management. I'm accompanied here by distinguished speakers and professionals, Stella, Alex, and Ioannis. They will help us to discuss about the topic that is not the most well-known, let's say, topic in group treasuries. Risk management, financial risk management, it's a topic that became very relevant the last few years with the extreme volatility that we saw in the markets. But if one think, how relevant is for the group, for a relevant firm, the financial risk management, will understand that each role is huge. And why I'm saying that? The results out of the financial risk management policy do affect directly the bottom line of the results of the company at the level of EBIT, which is for the most of the companies out there, is one of the primary KPIs, right? So whatever you do in FX, whatever you do in commodities and how you risk them is extremely important for the KPIs that the CFO and the management team, let's say, will have for each company. Interest rate risk management, it's equally important. It does affect the results, typically EPS for a company. It comes below the impact, let's say, of the other results at the EPS, typically, of the company, the finance cost. But I would say that these three important items, FX, commodities, and interest rates, are extremely important areas to look from a group treasury specific, and relevant policies should be there. So today, we will discuss with the panel each of these relevant areas, and hopefully that will be an interesting discussion for you, and if you have any questions, we will take them at the end. Okay? So let me start with the interest rate risk management. Interest rates, we heard Alex earlier, interest rate moved at the highest level that we've seen globally across many countries the last few decades or so, right? So hopefully we are reaching a level where interest rates will start coming down, but still we are still at 4, 5, 6% in the developed markets, and big double digits on the emerging market front. So we have countries with 15, 18, 20% interest rate, especially if you look in Africa, etc. So certainly, this is something that comes to the group treasurer's, let's say, desk, what you do with interest rate risk management. So starting with Stella, at Aegean, Stella, how did you address all this interest rate volatility that we had the last few years? How did this affect anything that relates to funding, to debt, and hedging policies? Can you give us a bit of insight on this one?
Sure,
Thank you,
Dimitris. For sure, high volatility makes decisions even more difficult. Decisions on what part of your exposure should be hedged and when it should be hedged, because you need to make a decision on where you are in the cycle. So for sure, the decision making is even more challenging at the moment. And at the same time, high interest rates, as you mentioned before, affects all industries, but it for sure affects the airlines. It affects the cost for financing your aircraft. And again, depending on when you are in your cycle, in terms of your investments, it affects you to a greater or a lesser effect. So how we have been managing that exposure, I guess the same way we have been managing the rest of the exposures that you mentioned. When we placed the order for new aircraft back in 2018, and when we contracted the majority of our finance and operating leases, we knew what the exposure was. So we hedged part of it. So we are partly protected where we are right now. We are not unaffected for sure, because apart from the direct exposure, there is the indirect exposure on your cost base, because in a high inflationary environment, all your costs are rising. So you are facing that aspect as well. And at the same time, what is a company specific, we have managed to recover strongly post-pandemic, generating a strong cash flow, which enabled us to repay debt, and which enabled us to do something that actually we announced yesterday that we have never done on our 25 years history, finance aircraft 100% with cash, which is not the normal. Of course, you cannot do that for your majority of your fleet, but I guess this is a change that has been facilitated by the current environment, that has been dictated by the current environment, by facilitated by our balance sheet and our cash flow. No doubt, the volatility requires a strong cash flow in order to weather the mark-to-market on your balance sheet. But overall, this has been the approach. Plus, we have been proactive with the help of Eurobank as well, back in 2019, where we raised our first bond, and we fixed part of our exposure back then. So overall, this is the outlook, and this is how we are managing that exposure on the debt side and on the balance sheet side.
Sure. Certainly, the risk is not gone; it's there. And great news to hear that you are paying. You are able to finance 100%. Let's say the new fleet. So great news. Yanni, Eurobank. We heard about from Stella the help that you are providing there. If we go back, let's say a couple of years, where this whole party with interest rate increases, started, and you see the type of questions, the type of inquiries that you got from clients, right, like Aegean, and the type of offerings that you as a bank, let's say, have for your clients. Can you give us a bit of color? What this interaction actually involved, and how you were addressing the inquiries from your clients?
Yeah, thank you, Dimitris. I think that this current upward rate cycle had been communicated early and clear enough since the late of 2021, early 2022, where the spot rates, Euribors, were negative, and even the front end of the swap curve was at minus 30, minus 40 basis points. And we realized that many corporates had already started to think about the situation in detail. As a proof and as an indication, the first vanilla trades that we executed were at negative fixed rates from those corporates that were able to accept the liquidity impact in their floating rate side this time. It was the contrary regarding to the past. Most of the trades were at floor swap at cap at strike 0, followed by vanilla caps at 0 or at in the money strikes, collar, three-way collars, and we're receiving theirs for a few options. As far as the tenor, range from 5 to 20, 22 years. The longer ones were for the project and structural finance trades, where there is still a huge pipeline, so we believe this hedging will go on. As far as the lower part, let's say the smaller corporates, we realized that they enter the market late, the later stage, where the fixed rates were already near 3% or higher, and they were waiting for a retracement of the rates in order to hedge. This never happened in a consistent way, and when it happened, I think that they reacted again late, so I believe that most of the smaller corporates were still unhedged. We see interest in fixed rate loans as well. We believe that hedging through derivatives is a much more flexible and efficient way. And as Stella said, the last years, and especially since the beginning of 2021, there were 6-7 issuers that came into the capital markets that fixed their exposure by raising even new funds with a fixed coupon, mainly in the Athens Stock Exchange. On the contrary, let's say, I would say that the early entrance into the market, those with a negative or low cost of fixed rates, were ready to unwind their position, realizing that we are near the top of the policy, central bank's policy, and the swap curve had, as the swap curve had started to invert it. Finally, regarding the cost of hedging, including XVAs, the so-called XVAs, range from 7 to 25 basis points, regarding on the tenor, on the structure, and on the internal evaluation of credit standing of the client.
Yeah, small follow-up question, Yanni. Do you think that the interest rate risk management is something that is, is treated within corporates the same way as FX and commodities risk management, in the sense that there is a continuous program of interest rate hedges coming, let's say, to the bank for inquiries, etc., same as it happens for FX or commodities probably, or it's something opportunistic that has to do with a potential bond issuance?
I think during the last year we see a serious interest because the numbers are big enough. The project for infrastructure or from renewables, for example, in many times are 3-digit million euros. So I don't believe that it's an opportunistic. I put it in number 2 as a priority for the corporates in general after FX. But I think that there is a growing interest for more and more corporates going forward.
Clear. Thank you. And Alex, you did cover it to an extent earlier, the impact of volatility and interest rates into your credit assessments, etc. But can we be a bit more, can we zoom in a bit and see, okay, interest rates were at 0, corporates had 0 finance costs, or they were even get paid, some of them, for issuing paper. Now they started paying the 3%, the 4%, the 5%, the 6%, depends on the funding cost of each company. Is this a big risk for you? I mean, do you think that either in absolute terms, this is a big cost for a company, so it has a negative credit impact potentially in the results of the company, or as a gap risk, refinancing, let's say, of a potential bond issuance? Do you think that this becomes an even bigger risk these days?
I think for the companies that were paying 0%, it's not a big risk. So it really depends where you are on the credit spectrum. If you highly rated, a big bond borrower, interest rates change and actually nothing happens overnight. You've still got your fixed rate bonds that are out there. So a lot of the portfolio just isn't seeing any impact or a very, very slow impact. Where it becomes important is where you have floating rate debts, obviously bank loans, also leverage loans, and those leverage loan borrowers, it's in the name, they've got a lot of leverage as well. So a lot of debt and floating is not great. But then we do stress tests on them, and even doing that, it's very hard to get them below 1x interest cover. You can get pretty close, and it gets a bit hairy. But paying interest is rarely the thing that's really breaking these companies. It is, as you say, the refinancing. It's when you layer on not just base rate rises, but often a doubling of credit spreads for some of these borrowers, and they suddenly work out 6-7 times leverage. That's not a capital structure I can work with anymore. So they need to take action. I mean, luckily, most of them refinanced in 21. So the time of reckoning is going to be in 3, 4, 5 years, and you can change your balance sheet over that time. So there's some time to sort it out. The problem and the defaults we're seeing is the companies that couldn't refinance in 21. And they're having to deal with it now, and the only way they can often deal with it is by some sort of exchange, which we're often calling distressed and calling defaults.
Okay. Let's hope by then, 25, 26, interest rates will drop. So it will be an easier job for treasurers. Okay, thank you. Thank you for your feedback on the interest rate risk management. We'll move now to another extremely important area for risk management, commodities risk management. It is the area which, most of the, I would think most of the group treasuries are not that familiar. And I heard Ioannis saying earlier that it is interest rates, effects, and then it is commodity risk management. But with the volatility that we had the last few years in raw materials, the extreme inflation that we observed the last few years, I think it's becoming more and more apparent that a focus on the commodity risk management policy makes tons of sense. So zooming in a bit on the commodities risk management, I will ask Stella in terms of the challenges that they had the last few years with, I don't know, in particular Brent, jet oil, or the relevant stuff for Aegean. How did you address all this risk? How your hedging policy was, tackling all these issues, and how is adjusted, taking into account the market volatility that you have? You can give us some insights there.
Well, we have been quite active, and we need to be very active because of the industry that we are in. Fuel costs accounts for around about 20 or 25% of our cost base. So imagine a shift from $70 to $100 a barrel makes a huge difference on our P&L. So we need to have some kind of certainty on our costs. Hence, we have been hedging that exposure systematically, as you've asked Ioannis, so more than we have been doing with the rates. And we need to do that to have certainty on our P&L, avoid volatility, and actually because we are also a listed company, this also makes a difference because investors want to have some kind of visibility on your costs and want to know how you're managing risks which you cannot control, and hence you need to hedge, hence you need to have policies in place for that kind of risk. So from our side, we try to be as simple as possible without adding complexity to our business when it comes to covering your underlying exposure. So our underlying exposure is jet fuel. This is where we do the majority of our derivatives transactions. We hedge the jet fuel so as to avoid what we have seen last year with the sharp increase in crack spreads. And also to have some kind of simplicity in terms of accounting treatment as well. Big challenge. I need to mention, of course, what happened with COVID. When a policy that was an insurance policy to protect your P&L turned the other way around. Of course, that has been extreme. It happens once every 100 years or so when you need to ground your fleet, when you don't have the underlying exposure that you have been hedging. So you have 100% of the cost without having any benefit of offsetting. So that has been the clear challenge for us. Hence, we stopped hedging because we didn't have visibility of what the business would look like in the next 6 months ahead. Once the business recovered, we resumed hedging and we resumed again a systematic approach and fixing part of that cost.
Okay, and I mean, the last few years were good in order for for management teams to understand that the impact of commodities effectively on the P&L, raw materials, and the need for such commodity hedging policies, I understand, correct?
But again, it depends on the industry. I mean, most of our peers, the listed peers, hedge their exposure. Most of our investors are asking about this. So it's a necessity for us, and it's of course supported by the board. The board can make a decision to go the other way around. So it's 100% a board decision on the direction. But again, because it's the airline industry, you're managing multiple risks. You cannot control the price of oil, so you need to fix part of that.
Yeah. Okay, super. Thank you. Yanni, in terms of the approach the last few years and interest from non-financial corporates on the commodity hedging side, I mean, what are the typical commodities that you would typically address in hedging with your clients, with non-financial corporates, the type of tenors that you will be hedging, the type of instruments that you see getting used? I mean, options in FX are something very common. Options in commodities is something probably less common. So can you give us a bit of insight on that type?
Yes, we received a request for quote, let's say, in oil, WTI, Brent, or a few other liquid refined products, base metal, of course, national gas, and a few requests for electricity. The tenor was shorter than the previous years, let's say, ranged from 3 to 12 months. We focus on corporates that do not have access to many alternatives, as the top name, who get access to physical traders, big brokers, or even members of the exchanges. I think that many corporates try to enter the market at the very wrong time, when the spot prices were quite elevated, and the shape of the forward curve, let's say, with the commodity was not the ideal one. As far as the structures, of course, the majority was Delta One structure, like Aegean swap, forward, one-day forwards, but we receive requests for caps, or even purchase for a puts for those corporates that wanted, let's say, to opportunistically exploit the high level of the prices in order to protect the value of their stock. As far as the use of credit lines and daily margin postings, I think that the liquidity of the corporates absorbed this issue quite well, with the liquidity accumulated during the COVID area.
Right, sure. Thank you. And just to add a couple of thoughts on the back of this question, when it comes to the tenor, and this is a topic that we discussed with Ioannis previously, is the commodities are one of the few risky assets that give you the opportunity to hedge long term, because many times we saw that happening across a number of commodities. The forward curve is backward dated. So you are in position to lock better rates from the ones that you have on the forward, on the front end. So long-term policies for commodities hedging, 3 years, 5 years, make tons of sense. And we're giving a bit of color from our Coca-Cola Hellenic, let's say, perspective. We do go there, and try to hedge ourselves up to these tenors if opportunities, as the ones mentioned, are there. Another small item, which is a topic that came in the discussions of the Financial and Risk Management Group, is the accounting treatment of all these policies. We don't cover it explicitly here, but it's important for the ones that they're looking to introduce commodity hedging to have a good discussion with their accountants, the financial reporting managers, because accounting treatment is not as straightforward as in other financial derivatives as FX or interest rates. Okay.
If I may add something, Dimitris, the logistic obstacle of the commodity hedging, we found that many corporates were reviewing is that documentation, for example, for first time. The basis risk was another issue, which is rather easy to explain, but difficult to be accepted by the Treasury or the higher management. And the third way that we said before, we find commodity hedging as not so well prioritized into the commercial hedging policy, and many realized the commodity risk back in 2022. So I think in the future they will more prepare many corporates to touch this risk in equivalent way with the other two pillars. Let's say.
Certainly. Alex, please.
I know we need to move on, but
no.
Just very quickly, when we speak to companies about this, the one thing that surprised them over the last year was the need to post collateral and margin calls. And we saw some of the big utilities really being caught out by these events that should be, real tail risks. And those were happening every 5 minutes in the last couple of years. So something else to think about in the very broad range of risks is, what are those worst case scenarios and how can that affect my liquidity?
Yeah. And Alex, from a rating perspective, and you deal with tons of clients, having a commodity hedging policy in place for non-financial corporates, how important is for you when you're actually going there and you try to estimate how the cost of a company, how the COGS of an entity is going to evolve in the next few years? Does the commodity hedging policy provide you any kind of comfort?
It helps eliminate short-term peaks and troughs. So if there's a short-term spike and it flattens it, that's great. The policy you described, that's very long-term hedging. We rarely see people being able to hedge fully for 3 years. That's quite something. So what it means is it postpones a shock. But if you have something fundamental like energy prices rising, that comes through eventually. So you need to, the company will need to deal with it. So it's a positive. But you can't put off the bad news forever.
Right. Thank you. We're coming closer, let's say, to the most well-known risk out there, which is FX. I doubt if there are corporates not hedging FX risk, especially the ones that have multi-countries type of operations. So FX has been extremely volatile. It's always been volatile, but the last few years has been extremely volatile. You can see that in the G10 currencies, but you can see it obviously in the emerging markets and frontier front. Those markets, the emerging markets and currencies, have been disproportionately affected by what is happening on the developed world the last few years in terms of FX. So whenever you see this dollar strengthening that we had the last few years, obviously there is a big impact on the emerging markets. So most of the companies tend to have hedging policies in place. And starting with Stella, Stella, can you give us a bit of color on how you're approaching the hedging of FX risk, transactional and translational risk, what this meant the last few years, what type of instruments you utilize? Can you give us your insights there?
Yeah, sure. There is, again, a huge exposure on transactional exposure on the dollar as a European airline. We have most of our revenues in euros. Most of our costs are in dollars. This is, again, airline specific. Everything in the airline industry, aircraft is valued, traded, sold, leased, financed in dollars. So though we have been hedging fuel for like a decade now, we have been hedging FX for more than that. Clearly because of the size of the exposure, and clearly because our business has grown, and so as the exposure to the dollar has grown too. So in the same way as with the other exposures, we try to be as simple as possible to identify which is the underlying exposure. Use derivatives to match exactly that underlying exposure. Have forecasts, use forecasts which are reliable as to what your future needs are going to be. And lock part of that exposure and leave part of it open to participate on the market movements. Again, you need a policy for that. You need to have options in terms of your counterparties to hedge with, and you need also to have a balance sheet, a strong balance sheet, in order to sustain the mark-to-market volatility. We don't have so much translation risks as I suppose you do. The main change that we need to address since 2019 had to do with, again, accounting policies, because as of 2019, we show on our balance sheet all of our operating leases. So because these are revalued on each reporting period, you have a mismatch between your assets and your assets which are not revalued and your liabilities which are revalued. So we use part of our cash, part of our derivatives to hedge that exposure as well.
Thank you. Clear. Yanni, same as for commodities and rates. FX, I guess, has been there for years. How was the experience the last few years where we saw the extreme volatility in markets in terms of offerings towards the clients, type of inquiry, sophistication? I guess options are more relevant here. Give us a bit of color there, please.
I think that 2022 and the first half of 2023, it's a record period on delta, on trades executed, orders received, or even the volume double in some products and crosses. I think that it's quite reasonable due to the excessive volatility that many corporates are more aware and sensitive than in the past as they grow further into new markets and in some cases in non-Euro markets. Furthermore, they attract many of our clients foreign investor attention. So I believe that they should exhibit that they handle this risk in a proper way. As far as the structure, I agree with Stella that we focus on conservative ones like forwards, flexible forwards. We see, of course, option structures, not many vanilla, knockout forwards, and some more structured, tailor-made ideas. I think that the FX risk on the corporates was augmented by the excessive volatility on the raw materials prices, because of the euro-dollar trading below parity, as most of the client imports in foreign currency in dollar, for example, and due to the spike of FX volatility. Around 85% of our volumes executed in euro-dollar crosses, followed by 10% in sterling pound crosses, but we saw interest larger than before in Aussie dollar, SEK, NOK, Turkish lira, ZAR, Polish zloty. And it was to note here that around 30% of our trade volume executed came through our platform in e-banking, which shows that corporates are ready to adopt digital channels in order to trade even in 24-hour basis. As far as the cost, the market cost, due to the widening of euro-dollar rate difference, we see the forward pips widened during 2022. They retraced in the middle, in the early 2023, but still there is a premium of around 1.75% in favor of the importers, and at the cost, of course, of the exporters. Finally, as far as the FX volatility, I think it's a welcome element by our client, because corporates usually sell volatility forward, so they prefer to secure, to ensure, let's say, that they have access to a much better hedging price at a higher risk, of course, but they consider that the risk will not materialize at the end.
Yeah. Obviously, with higher interest rates, higher interest rate differentials, hedging becomes an even more challenging exercise, more expensive exercise. Right. And Alex, your view about FX, I guess.
Two very quick points.
Yes.
Firstly, the simplicity point that I mentioned. A medium-sized corporate with a very complicated derivative book is a bit of a red flag for us. So if you can't explain your hedging position quite clearly, then that's something you should potentially think about as a treasurer. The other point is we shouldn't just think about financial instruments and derivatives. So when we analyze companies, what we're most interested in is the structural elements that hedge. So have you got debt in the same currency as your revenues? What currency are your costs in? And that's a long-term fundamental way to make sure your volatility in your leverage metric, your results, is manageable. So that's the real focus. We spend a lot of time gaming how different movements can affect metrics, but it's mainly that rather than shorter term, or what are typically shorter term FX hedges.
Indeed. Now, as we need to slowly wrapping up. Let's go to the last risk, which is, it's a risk where counterparty risk. It's not actively managed, I would say, by financial derivatives. One would expect that it's not actively managed by group treasuries, but it is there. I mean, we saw it being relevant in US, in Europe, without mentioning names of banks, but it is there. I mean, it's always there, but the last year or so, it became very, very apparent. So, counterparty risk policy, how you're addressing that, Stella?
Yes, that's indeed very important. You have, as a treasurer, a responsibility to protect the company's interests, and you have a responsibility towards your board. You need to monitor that. You need to evaluate that risk. You need to have diversification across your counterparties, across the countries that your counterparties are based in. That's indeed very important, I would say, approaches that need to be followed. So diversification and constant monitoring on that front.
Diversification, a big word, yes. Okay. And we understand that, when you have to change something in counterparty risk, you want to move from one bank to another because you have some consensus, etc. This is not a straightforward, action to implement because you may get phone calls from banks, etc., etc. So it's, yeah. Okay. Yanni, Alex, your views on the counterparty risk.
So I didn't go through it too much in the slide I showed up, but if you look at the sectors where there's risk, and obviously there are people that provide things like credit ratings, which gives you some sort of idea as to how strong your counterparties are. But if it's not rated, and you're thinking sectors, the ones where we're seeing the biggest risks are anything consumer-facing. So retailers, consumer goods. We're seeing real estate having some issues, but it depends where you are in real estate, and things with a lot of leverage, as I think I've probably done to death by this point. But the important point is really differentiation. Understand your big suppliers, your big counterparties, and maybe just look a little bit further into their business models and see if they're exposed. We're seeing most companies are doing fine. So most companies, revenue's going up, they're able to hold their margins, which actually means they're able to deleverage. But fundamentally, it's very differentiated, and it's about just watching their results more closely than you might have done otherwise.
Okay.
Fortunately, from our side as a sales unit, we didn't experience any bad incident, let's say, the last 3-4 years. Most of the trades, the heavy trades, are in the rates where the mark-to-market is positive. So we don't face any significant counterparty risk right now. And I hope that clients were looking to the bank with the same attitude, let's say. The Greek banking system is in a much better situation than in the past. And we don't see, let's say, an issue for the next 2 or 3 years where the rates may have peaked and the interest rates and the refinancing needs of the corporates coming to the surface.
Okay. Thank you, Jan. I think we did cover all the main topics on the financial risk management across the 4 pillars that we mentioned in the beginning. I think we do have some questions. I'm not sure if we will be able to address them. A couple of questions, certainly. So, first question from Nikos Polymenakos. Is it still time to hedge against interest rates, or is it too late to do so? Okay, that's the million-dollar question. I mean, I'll say a few words, and then the team can actually say also. It depends on the policy that you have. It depends if you're approaching things opportunistically with the potential bond issuance, or if you have a program in place. From 0 to 100, there is a middle ground. So, you don't need to hedge 100%, but partially, and according to your Treasury policy, it probably makes sense to hedge no matter where the rates are. So, I don't know if the team wants to add anything.
I fully agree, but it depends on the structure that you may select. It may be late to select a Delta 1 hedging, but there are other alternatives like collar, caps out of the money in order to protect an absolute maximum of your cost. And there are many researches with backtesting and simulation showing that it might be too early in some cases. Too late, I would never suggest to a corporate to put it out of their mind, let's say, that I should not hedge. Even if rates were at 4%, there might be some residual risk. And I think that the short-term risk, even today, is slightly higher. We may have a different approach in 6 months' time, but we still see interest. And depending on the structure, for a project finance, it's a compulsory, let's say, element of the project. For to hedge a working capital, it depends, as Dimitris, you said, on the policy and other issues.
Okay, let's get one more question. Thank you, Yanni. On the a question that attracts quite a lot of attention. With high interest rates and the economic environment, from Nikos Daskalakis, being negative, do you see any systemic risks regarding corporate debt? And what should treasuries do? I mean, let's hear Alex if he has any views on the systemic risk.
Yeah, no, I think is the short answer. So we were worried about a year ago when the market seemed closed, there were no transactions, there was a risk of money flooding out of the system. It looks, I'm finding some wood to touch, it looks like we're over that. Retail investors starting to return to debt, you're comparing debt to equities. It looks like we're in a more comfortable position where we're gradually getting back to normal, albeit it's slow and steady progress. I can answer the next one quickly as well, it was the inflation one, 25. So it's going to be sometime during 2025 we might see those targets being hit. It's going to take a while to get down there.
Okay. I think we are running out of time. It's been very interesting hearing your views. I hope the audience find it interesting as well. Many thanks for your attention.
So